Hello to everyone. I am Nicolas, Bornozis, President of Capital Link, and I would like to welcome you to Capital Link's Trending News series. In this episode, we speak with Mr. Aristides Pittas, Chairman and CEO of Euroseas Ltd, about the company's recent developments, second quarter performance, and strategic priorities going forward. I'd like to mention that the Pittas family has been in shipping for over 140 years. Now, Euroseas operates in the container shipping sector, and its current fleet consists of 22 vessels, 15 feeder, and 7 intermediate container ships. With the 2 new feeder container ships to be added in the fourth quarter of 2027. Now, Euroseas common stock is traded on the NASDAQ capital markets under the ticker symbol ESEA. Now, before we start, please note the usual disclaimer, which is fully described on the opening slide, that this discussion is only for information and educational purposes. It's not investment advice. It's not an offer to buy or sell securities. And by the way, Capital Link is very proud to serve as investor relations advisor for Euroseas. Now, let me start our discussion with the reflections on the second quarter performance. Aristides, thank you for being with us. Can you walk us through the key factors that influence your second quarter performance and how these results align with your expectations for the remainder of the year?
Thank you, Nicolas, and thank you everybody for listening in or seeing this webcast if you do. I am just about ready to go for my holidays, and as you can see, I'm in holiday dress code. We indeed had our quarterly conference call today to discuss the results that we announced, which was a profit of about $30 million. This was planned, I would say, because all our ships are on time charters, and we know exactly how much money they will be making over the whole of this year. And there have been no surprises. The profit was extremely good, and we expect that the next couple of quarters are going to be very similar, just because the ships are fixed. We have only 1 out of the 22 ships in our fleet that will be rechartered sometime in November. So all in all, very good results this quarter. We expect similar performance the next couple of quarters and even the first couple of quarters of 2026. With that in mind, we were able to increase our dividend. We increased our dividend from 65 cents per quarter to 70 cents per quarter. This is an increase of about 7.8%. It gives a dividend yield of around 5.5%, which we are certain, that we can continue over the years at least.
Thank you, Aristides. We'll talk about your dividend and the capital allocation overall further down in our discussion. But let me now turn to the container market outlook. With charter rates for feeder vessels remaining strong and Panamax segment showing some softness, how do you see rate trends evolving across different vessel sizes for the remainder of 25 and possibly into 26, especially given the ongoing Suez Canal disruptions and recent U.S. tariff measures?
I think the outlook for the short term continues to be extremely strong. I don't think we've seen a reduction in charter rates for the Panamax vessels. We haven't seen a lot of fixtures, but this is mostly because of the lack of vessels rather than the market softening. The market will remain strong for the rest of this year and the first part of next year for sure. Now, the outlook further out is much more difficult to predict because we have these 2 very important unknown factors that really affect this. One is the tariffs and what effect they will have in the global economy and how they will finally settle. And there is a potentiality for the market the global economy slowing down a little bit. This is one risk that we can see. And the other risk, which has more to do with our business, is what will happen with the Suez Canal, and if the Red Sea events, the Red Sea situation will correct itself, and we will start seeing vessels transiting the area, because that would be a negative for us when it happens. We don't anticipate it will happen soon, but when it happens, it will result in more ships sailing through the Suez Canal, therefore effectively increasing supply of ships. So this is the tailwind risk, but the next 2-3 quarters, I'm very confident we will have still a very good market.
Thank you, Aristides. Let me stay on the supply and demand fundamentals. You pointed out in your earnings call the difference between the dynamics of the larger vessels and the feeder and intermediate segments. So the feeder and intermediate container ship segments have small order books and an aging fleet profile, which could create favorable conditions for owners. We have actually seen a flurry of new building activity in this segment, a lot of interest from owners. How do you see these supply fundamentals playing out over the next 2 to 3 years, and what demand drivers are most critical in sustaining this advantage?
You're absolutely right, Nicolas. The market, the container market, if you look at it as a whole, seems to be that it will be oversupplied. But if you look at the smaller sizes, the math is totally different. The situation is totally different. There will be less ships around in a couple of years than what there are today. Despite this flurry of new buildings that you say, still the order book is below 7% for this size of vessels. So, and the fleet is extremely old. More than 20% of the fleet is over 20 years old. So definitely we expect to see still, despite the new buildings, a shrinkage in the size of the smaller ships. So this gives us confidence that even if demand drops significantly globally, and that will affect the larger sizes, the smaller sizes are somewhat insulated. We can never say that we are totally insulated, because all container ships carry the same cargo, a container box. So there is a cascading effect happening between the bigger and the smaller ships. If rates for the bigger ships drop, they are bound to drop for the smaller ships, but not that much and not so severely.
Thank you, Aristides. Well, on that topic, I wanted to ask you, I wanted to talk about geopolitical and trade flow impacts. And you already talked about how geopolitical tensions and are altering trade routes, and how we have all the security issues in the Red Sea and so on. All these create inefficiencies that, in your view, could impact the overall container demand and fleet utilization. But let me ask you, you spoke about that already, but are these tensions going to impact the larger vessels and the feeder container segment the same way?
I think that the smaller container sector might even benefit because of this, because there is a lot of rerouting happening and ships having to go to different countries and smaller ports, which is a positive thing for us. But still, it's very, very difficult to make a case about how things will develop. The one thing that is certain is that all these tensions and all these trade changes are creating inefficiencies, and inefficiencies are always very good for shipping.
Indeed. So let me now go to asset value trends. We've seen second-hand prices rise by about 4.1% in the second quarter in the feeder segment, despite the market uncertainties, and new building prices remain firm. Now, what is driving the resilience in asset value, And how do you expect this trend to hold as order books continue to expand?
Well, obviously, the resilience in the values is there because the charter rates are extremely high. And at current charter rates, you repay even the much higher prices that you pay to buy some ships. So if and when we see a reduction in charter rates, we will start seeing a reduction in the prices of the second-hand ships. For new building ships, I think the situation is a little bit different because new building prices have increased not only for container ships, but for every type of ship. And they have to do with the increasing the cost of construction of the ships. Both labor is becoming much more expensive in the countries that build ships, which are mainly China, of course, Korea and Japan as well, but China builds the majority of the global fleet today. And there, the labor costs have increased substantially, and of course, the material and the equipment that has also increased. So I don't really see how, whilst I see that second-hand vessels prices will drop if charter rates drop, new building prices, I doubt that we will see such a drop. They will be more resilient. There might be just a small reduction in that.
Also, I think shipyard capacity seems to be fully maxed out now.
Shipyard capacity is exactly as you say, fully maxed out. If you order a ship today, you can't expect a delivery before 2028 if you're lucky. Yards are quoting 2029 deliveries these days.
So now let me turn to capital allocation. You already talked about the increase of your dividend. Your quarterly dividend, you increased by 5 cents from 65 cents to 70 per quarter, which I think annualized, based on the current price of the stock, is about 5.5% yield. Now that's quite attractive compared to your peers. Also, you have continued with your share repurchase program, and if I'm not mistaken, you still have another 9.5 million of authorized capacity to go. So how do you determine the optimal balance between rewarding shareholders, pursuing fleet growth opportunities, and strengthening the balance sheet? And how could this balance evolve over time, given current market conditions?
Well, one thing that we all know is that shipping is a very volatile business. So whilst today we are making very significant profits, there might come a time that we are not. We are determined to try and stabilize this market for the benefit of our shareholders. And that is why we have decided that we want to offer a stable dividend yield to our shareholders. We want it to be definitely above 5%. We don't want to do some other companies that have a full payout strategy and pay out everything, because we know that the difficult times will come and then we will not be able to pay a dividend. Our idea is to have a steady, positive, satisfactory dividend yield over the years and reward our shareholders in excess to that through the repurchase of stock, through the growth of the company, through the growth of the stock value. And this is how we have decided to act upon that. We are only paying about 20% of our net earnings today as dividends. It's because the markets are very good. We are keeping the capital to help us grow the company further and to help us have reserves for the difficult times. We will pay this good dividend even in bad times. This is the plan, this is the intention, and this is how we're strategizing.
And Aristides, if I can add to that, I think given your fleet deployment strategy, with based on charters, with staggered expirations, you can really manage in a way your exposure going forward.
Definitely. We have been helped by the good market in that there is availability of longer term charters of between 2 to 4 years time, and we've taken advantage of that. In bad periods, you can't really do that, but now that was available, we took it, we got the certainty of the capital flow and of the profits, and we are building on that.
So now let me go to the competitive positioning with your fleet expansion. You're going to reach 24 vessels by late 2027 when you get the two new builds on board. Now, how does this expanded fleet profile shape your long-term competitive positioning, and what is the company's next phase of growth?
Well, as I said, we have very significant reserves to acquire more assets, and we will be buying more ships, second-hand ships if prices drop, maybe more new builds if prices don't drop. So the company will continue growing in that way. We are quite happy that we've reached a level where we are looked upon investors very similarly, I would say, to the other even bigger container companies than us out there in the universe, and considered, equal to them and maybe even a little bit better stewards of capital.
Thank you, Aristides. Now, let me conclude our discussion with a question on your 2024 ESG report. You just published it. It was the 5th edition of this initiative. So can you discuss the most notable progress achieved since the last report or since the first report, and any new targets or metrics that you introduced this year, and how your ESG strategy is influencing operational decisions, stakeholder engagement, and long-term value creation for Euroseas?
I think our main target has been to modernize our fleet, and our ESG strategy aims to assist in that field, which has both financial implications and environmental implications for us. And as you've seen, we've put orders for quite a few ships which we took delivery over during the last few years. We placed another order. We're considering possible other orders of vessels that are much more fuel efficient and cleaner. So I think this is the main thing that one can say. But it's not only that. It's the mentality within all our company that I see is changing. All the employees are becoming aware of the seriousness of the environmental concerns that we all face. We are all becoming more conscious about our social responsibility, and the fact that we, having been lucky and successful over the years, can help shape both the way people think about the environment and the society and governance, and contribute. So I see it across the whole company that there's been a change in the mentality, and I'm very proud of how our employees are looking towards these aspects.
And to that effect, it's worth noting that you are also on the board of HELMEPA, the Hellenic Environmental Marine Protection Organization. So
this is something, Nicolas, that I started more than 10 years ago, because I always believed it's important to protect the seas, and it's one of my nice, I would say, pastimes, trying to help that. We provide a lot of material to schools all over Greece, promoting the environment and the protection of the seas, and this makes me feel very proud.
In Aristides, we have our Operational Excellence in Shipping Forum in Athens on September 30. Euroseas will be part of it, and we're doing it together with HELMEPA and with ABS as a partner. So we're delighted.
Yes.
So we reached the end of our discussion. If I can ask you for any concluding remarks.
No, enjoy the summer. Everybody enjoy the summer holidays, and because the world is changing and changing fast, and we have to think continuously how to adapt in this changing world.
Thank you, Aristides. Thank you. We had Aristides Pittas, the Chairman and CEO of Euroseas. Thank you for sharing your insight. This webinar will be available to access upon demand on our webinar website, www.capitallinkwebinars.com, and of course on Capital Link's YouTube channel. Thank you to everybody for being with us today.
Thank you, Nicolas. Thank you, everybody. Good day.